Welcome to the Invested Dads Podcast, simplifying financial topics so that you can take action and make your financial situation better. Helping you to understand the current world of financial planning and investments, here are your hosts, Josh Robb and Austin Wilson.
All right. Hey. Welcome back to the Invested Dads Podcast, a podcast where we take you on a journey to better your financial future. And today, we are going to be talking about giving.
Great. One of the things I know, my kids love giving each other germs. That is where it's at.
Well, not necessarily germs, Josh. We're going to be talking about giving as it relates to nonprofits. So you keep your diseases to yourselves.
All right.
We're going to try to avoid the giving of those.
I'm a sharer.
You are. Sharing is caring. You know, that's what it says on one of my daughter's kids shows that she watched. Sharing is really caring.
Was it Daniel Tiger? Because he's got a song for about everything.
No, I think she's got three options, okay? So three options, and they're all on YouTube, which is great.
Yep.
Three options are Little Baby Bum.
Little Baby Bum.
Obviously.
It's the best.
And number two, Coco Melon.
Okay.
And I like Coco Melon better. Coco Melon.
Little Baby Bum. Huh?
Coco Melon is a little bit more real world. There are still animals that do talk and stuff, but mostly kids and family. So I can do Coco Melon, and then it's Ping Fong.
Oh, yeah.
And Ping Fong that's Baby Shark.
That's what everybody knows.
Baby Shark. I usually make her watch Ping Fong in Spanish.
Just to give her some diversity.
Well, her name is Juliana, so it's Juliana. So it's her Hispanic heritage.
Yeah.
As I'm just saying, maybe your native language is Spanish.
Could be.
It could be. We don't know. Maybe. So anyway, we watch Ping Fong in Spanish on YouTube. It's pretty great. So yes, Josh, we are talking about giving as it relates to nonprofits. So I guess let's probably start like we usually do, 50,000 feet. We're going to say,
up high.
What is charitable giving?
Yep. So normally when we're talking about this, we're talking about charitable gifts from your assets to an organization, and normally that organization is a 501c3.
That's a lot. That's like Star Wars,
it's like a little droid of some sort. It's the tax code,
right.
And within the tax code, that's the section where it clarifies which companies are able to be tax exempt.
Right.
And so when you're giving to a charity, a charitable organization, or a nonprofit, just because they're called a nonprofit doesn't mean they don't earn money or have money. It means that they're not taxed.
Yeah.
Right? So the profits don't go distributed or anything. They're used for future.
Yeah, and I guess
costs,
technically it probably goes to ownership as well. These are not formed as like a sole proprietorship or a partnership or anything. The ownership is the entity itself, which is why those profits then get reinvested either into the entity or distributed to whatever those services or needs are.
Yep. So today when we're talking about 501c3, tax exempt, nonprofit, charity, those are all kind of interchangeable about what we're talking about.
So here's a fun fact, Josh. There are about 1.3 million, with an M, 501c3 organizations in the United States today.
And I do know.
That's a lot.
So yeah, those are, and there's other types out there. So there's like private foundations and all these other things that you can give to and all different organizations. But yeah, that's kind of the main giving organization is a 501c3, and there's 1.3 million. That's a lot.
And if you think there's only 350 million people in the United States, that's one for every whatever.
Yep. And there's they all are, a lot of them are focusing on needs or certain
very niche.
Yes.
Right. So another fun fact is that 92% of these 501c3s operate on a budget that is less than $1 million per year.
So there's a lot of smaller organizations out there.
Correct. And that's also why a lot of these organizations need donors. Mm-hmm. They operate on small budgets, and they're whatever niche market they're trying to do and need that they're trying to meet, they're doing that on the backs of donors. It's donor dollars that are making those things happen, which is why it's a wonderful thing. It's a need, though. But a lot of them, they don't have billions in the bank to just make things happen here.
And those are more the private foundations.
Correct.
And, we're not going to talk much about those, but if you're an ultra wealthy person, sometimes you create your own private foundation, and that has its own rules on giving and all that stuff.
Right.
But you, in a sense, have more control over how that's distributed, but that's a whole other topic.
So let's kind of break down how those funds are acquired for these nonprofits in general. So nonprofit revenue comes 32% from government grants. So there are the government entities know that these are great entities or organizations that meet needs that actually the government can't or doesn't want to meet.
Or is not as efficient at it.
Right. So it is the government knows it can't do everything. So it is going to offer some incentives, whether that be credits or grants or whatever that may be, for these organizations to do things that the government's not going to do.
Yep.
So they're happy to support that. That's happened. So 32%, so about a third comes from government grants. 14% comes from donations, and that's from people like you and me who are giving our hard-earned dollars to the these organizations that we feel led to.
Yep.
Half of the overall revenue comes from private fees and services. So kind of go into that a little bit.
Yeah. So you say, wait a minute, you just said it's a nonprofit. How do they have private fees and services? All right, here's a good example. My kids are in sports, and we play in the local rec league here in the area, and they are actually a nonprofit organization, and you pay, though, for your team to participate. So when you sign your kid up, you pay the registration fee. That fee goes into the nonprofit. They use it for their overriding expenses and to cover the referees and umpires and everything like that. But there's a charge. And that's what this is talking about. Another example would be Boy Scouts or Girl Scouts, another nonprofit organization,
right?
But you pay to be a part of that. So those are the private fees and services that they offer. Is they're still a nonprofit entity because of what they do and how they're structured, but they charge to be a part of that.
Yep.
Nothing wrong with that. Nothing illegal. But you can see a lot of nonprofits, in order to maintain themselves, have to charge something.
If there are
49%
costs,
of that revenue comes.
If there are costs associated with the service you're providing, then you have to have income in some way, shape, or form. It ain't free. There is no free lunch. We've talked about this. I love lunch. It's just not free. And Josh, guess what?
What's that?
There is in one more bucket.
If you do the math,
you do the math, we're at 95
plus 49%. That's 95%. Okay.
You have 5%, and that 5% comes from other.
That's a good bucket. Just drops in
just
there.
It's the catch-all. So we don't. That can be a lot of different things.
And it could be. And I don't know how they broke donations down, but if there's estate giving and stuff, which we'll get to later in this episode, but that may not count as a donation because the person's passed away, so it's actually not a donation anymore. It's considered a estate gift, and so maybe that's where that bucket comes from. I don't know. All right. Overall, though, if we look at giving, because we're going to be talking about that, in 2019, which is the most recent data I could find, $449.64 billion, so almost $450 billion.
Almost half a trillion.
Yes. Was given or donated in 2019.
That's a lot.
Yeah. And actually, it was a 5% increase, 5.1% increase from the prior year.
I wonder. So when we revisit this episode in the future, I wonder how that looked in 2020.
Interesting.
When COVID was going on, were people more or less generous?
Yes. And, there were some stimulus money where people got extra cash. Some I know we're talking about giving a portion of that away as a way of helping out.
You either bought Bitcoin or you gave it away.
One of those two.
Two options.
Now, I do know in this research that on average, the increase of giving overall, if we look at the overall giving in America, is about 1/3 the growth of the stock market for that year.
Wow.
I don't know how that correlates, but that's
interesting. Well, I mean, if you think,
I saw.
Let's put a round number on it. Say the stock market has increased 9% per year, because that's a nice divided by 3 number, historically speaking, which is pretty darn close to accurate. Then 3% is your average giving rate.
Yeah, increase. Yep.
Which is giving increase. So what that also means is that Americans are getting wealthier in general if they're invested in the market faster than they're giving their money away.
They're not giving everything that they're earning.
Exactly.
Yep. Which I guess if you look at that 5% increase, 2019, the stock markets were up. It was a pretty good year.
It was a really good year.
Yeah, maybe that correlates to that.
Maybe it does. Okay, Josh, before we dig into the nitty-gritties of this, I want to make you chuckle a little bit.
I'm ready.
So, Josh, I got a joke, and I got another.
Is this from Reddit?
Yes, this is from Reddit.
Okay,
r/dad jokes. I'm on it. It's my go-to right now.
That's where it's at.
I have 2 punchlines for the same joke.
Oh, there's 2 options.
I'm going to give you both.
Okay.
For number 1. So, why did the astronaut break up with his girlfriend?
Ooh, why did the astronaut break up with his girlfriend? I don't know why.
Because he wanted space.
He wanted space.
Get
That's
it?
Good. I like it because he's out and...
Punchline number 2.
Okay.
Why did the
other
astronaut...
reason. Okay.
Yeah, why did the astronaut break up with his girlfriend?
Yes.
Because she Cosmo problems for him.
Cosmo. I like it. Cosmo problem.
Reddit, r/dad jokes. I'm plugging that. That's good stuff. It's not all... You have to have a filter.
Yeah, you got to be careful.
We are very select
the internet.
about...
The internet can be...
and don't believe everything on the internet. So, anyway, that's your dad joke of the week, everyone. Hope you enjoyed it. So, Josh, let's have a discussion. Why? why would we give to charity? And I want to preface this by saying there are a couple, when you get to the numbers of it, there are a number of reasons to do it, okay? But in general, my opinion is that this is giving really comes down to your heart because you can give zero money away if that's what you want to do. And that is one way to do things. Yep. But it really goes down to your motives and what your values are and how you can align your finances with your values. Yep. And that is kind of how that works. So I really think that when it comes to charity and giving in general, it goes to what you're passionate about. And that's kind of my motive around the whole topic of charity. Yep. But you had a couple other thoughts on that.
Yeah. So if we're just talking high level, why would people be motivated to give? And like you said, the big thing is most people give, at least the organizations they choose to give to are the ones that they're passionate about. They do something, they provide a service, they're reaching out to the ones that you're passionate about. So, for instance, if you are passionate about animals, maybe you donate your time or your money to the Humane Society or something like that. So where do I find my passion? That is usually where my money will flow to. So, like you said, it's a hard thing. So, something I'm passionate about. But the other side is, when it comes to giving, there's also an incentive. There are tax benefits to giving.
True.
And so when we're talking about giving, a lot of times people will say, well, I want to give, but what's the most efficient way of giving, right? What is the way I can get the most bang for my buck when it comes to going that way? And that's what we're going to talk about.
Because you can give as much money as you want away, and if you don't track it well or put it in the right way that it should go, you're just giving it away, and you're not going to realize any of the financial benefits of the offset of it.
Yep.
Which we're going to hope people don't do.
So we're going to spend a little time on that. Now, there's a lot that goes into this, and there's a lot that you can do tax-wise when it comes to giving. So this is just high level, so we encourage you to speak to your advisor and speak to a tax professional when it comes to your unique situation. But high level, there's ways to give, right? So first, like we've talked about, is writing a check, right? Or if you don't know what a checkbook is, giving cash. Or if you don't know what cash is, using Venmo or some sort of app to directly give money from your bank account, all right? So the first piece is direct donations with your cash, all right? It's great. You can get a deduction on your tax return when you do that. In fact, last year, everybody got one. If they gave, even if they took a standard or itemized deduction, you got an extra credit on your tax returns. That was part of the stimulus bill. But in general, you get the value when you take an itemized deduction. Now, we've talked about that a little bit in tax planning, but an itemized deduction is where you say, okay, I'll put all my income in my taxes, and then I'm going to start deducting the different things that the IRS says I can reduce my income with. One of those being charitable giving. Now, the standard deduction is pretty high now.
That's what I was
The current tax rate is $12,000 for a single, and it slightly moves higher, but roughly $12,024 for a couple.
So you have to give a lot.
So you have to have a total deductions of over that to make it worthwhile.
Yeah, that can come from things like mortgage interest. That can come from things like giving. Those are the two big ones that come to mind.
Health costs.
Yep.
There's certain stipulations with that as well. So most people just take a standard deduction. So if I give cash donations or some sort of direct donations out of my cash, whether it's checks or however you want to do it, if I'm not taking an itemized deduction, I really don't get any credit for that on my taxes. Except for, again, this last year when they gave everybody one regardless. It was like $300 extra. So there's other ways of doing it, but that's one way, and I would say most people do that. Right?
Yeah, write a check. I'm going to write a check. Or whatever. Or I know a lot of places you can do it online.
Yeah, online or drop it in a box. Yep. You know, a lot of times you go to a state park and stuff, and they have a donation. You just drop some cash in there.
Now I will say this is a really good plug to say that if you are literally giving cash to something that does not have your name,
fold it in half.
What I'm saying is. Make sure that somehow you keep track of that, because you, at the end of the day, when you want to do your taxes and you're writing all of these deductions down, I always, regardless of if I plan on getting the standard deduction or not, which, like you said, is a lot higher, so most people take it, I always keep track of all of my giving so that I can run it both ways and see how it works out.
See which one's better.
So anyway, if you're giving cash, like suppose that you just give $50 at whatever, you have it in your pocket. If you don't write it down, you can't. It's hard. It's hard to remember that I did that on whatever day it was. But B, you don't have any documentation. Yeah. Even if you just write yourself a little receipt,
you got to prove it.
Exactly. So cash is a really hard thing to do. So a lot of I'm thinking of churches and stuff. If if you are a frequent member or whatever, they'll tie it to your name and give you statements and stuff, which is handy. And a lot of other 501c3s do as well. So it's tied to your name.
Rules about if you give a certain amount, they actually have to provide a receipt.
Exactly. So just keep track of every dollar that you give away to a qualified charity.
Yep. Along with that, since we're talking about it, we're talking really about giving money and assets, but assets are beyond just cash, right? So if you donate stuff to Goodwill or anything like that, that's actually can be a tax deduction, again, if you're in that itemized. So if you take a bunch of furniture or clothes or whatever, you can have them give you a receipt, and then it's your job to kind of put a value on that and make sure it's reasonable.
And there's formulas actually for what that stuff is.
Yep. But just keep that in mind, like you said, make sure you track it all. So another option is appreciated securities. That doesn't mean like, hey,
I like these. I appreciate them.
Not that. Appreciated securities are, let's say I bought something for $200 and now it's worth $1,000. It's appreciated from $200 to $1,000, so that's $800 gain. If I were to sell that, I would realize $1,000, and let's say I've held it for more than a year, so I have to pay long-term capital gains.
On $800
On $800 that gains. I owe tax because that's new money. I would then pay my 15 to 20% tax, and then whatever's left I could give to charity. But instead of selling, I could just give that security directly to a charity.
Yeah.
And I get to then take the full fair market value, that $1,000, as a deduction on my taxes. So
you're double saving there.
You really are. The charity gets more money, and I get a higher deduction on my taxes.
Right, because your deduction is the cost difference and the tax difference combined. Mm-hmm. So you're getting a double whammy, and the church or the 501c3 or whatever that is getting more money. So it's a good deal.
When you're comparing the two, appreciated securities, you get more bang for your buck during that time between cash and that. There are certain rules on how much percent of your adjusted gross income you can give between those two. The last year they said 100% of your income. They were just saying you could give whatever you want and still get a deduction. They were trying to encourage giving, but normally cash is 50%, and appreciated securities, it varies, but it's about 30%.
It's also worth noting that if you're going to do this, it is only going to be beneficial to do it in a taxable
we're going to get to that.
account.
Yes, but very good.
Yeah.
These are all things that are tax deductions, so they're in a taxable account.
Yeah. So don't look at your IRAs or whatever and be
we'll
like,
get to what you do with an IRA.
Exactly.
But yeah, so that's how you could do giving right now. Mm-hmm. Let's say I have some assets and I want to help out a 501c3, but I also want these assets either to continue to help my family, or in the end I want them back, which seems weird.
That does seem weird.
But there's ways of doing it. There's charitable remainder trusts and charitable lead trust. So CRT, CLT, and there's units within there. So there are CRUTs and CRATs and all these fun little acronyms.
Those acronyms.
Long story short, a charitable remainder trust. And the way you can remember these is how they're worded. It's talking about the asset to the charity. So charitable remainder trust says, I'm going to give something to a charity. They're going to then pay me some set amount for either a time period or the rest of my life, or however we set this up. And then at the end of that time period, they'll get whatever's left, the remainder. So that's charitable remainder trust. And so an example would be that a lot of universities do these type of things. And so there's a local university that I'm part of. I love what they're doing. And I say, you know what? I have this investment portfolio or whatever, and I'm going to gift it in this charitable remainder trust. It's an actual trust. And the trust dictates, okay, now it's in possession of the university. They own it now. I've given it out of my estate. Now we're talking about kind of this estate planning thing. Now I have fewer assets in my estate, which may be a good thing from tax planning and estate planning. They'll then say, okay, it was X amount of dollars. We'll give you this percentage annually for the next 20 years or whatever they set up. And so then I get this money in, and I can use it as to continue living the way I wanted to. And then when I pass, or when that 20 years is up, if they managed it right, it's probably not only still there, but grown, because the percentage they give, there's this whole calculation table they do, and now they have that asset for them. So that's great. Flip it the other way. Charitable lead trust goes the other direction. You give this money, they get a set income throughout this time frame. It's lead, so they get it ahead of time, and then when it's all done, it comes back into your estate or goes to your inheritance or wherever that's going. So there's two different ways of doing it, both directions. In fact, the charitable lead trust is actually really beneficial in times like now when interest rates are really low, because they value that at a future value. And when it comes back to the present value, because you're using lower interest rates, you get a higher present value, so you get more charitable deduction from that gift.
It's discount rate.
Classic. Really confusing. Don't worry about that. Only to know there's ways of giving assets to either provide income or to give income to a charity and then get the asset back later.
Yep.
They're deductible in taxes. Again, talk to your CPA about how it fits, because they are trusts. They have to be worded correctly and fit in there.
CPA and an attorney.
Oh, talk them all.
Talk them all.
A lot of people to talk to. But for certain groups of people, it makes a lot of sense.
Absolutely. Josh, one more acronym.
Yes.
I love acronyms.
Acronyms are the greatest.
Give me one more.
Yeah. QCD.
Ooh. Yes. I'm going to make up a word for this.
Yes.
Questionable.
Yep.
Charity. Disbursement.
No, that's when they're doing weird stuff. No, that's not what we're talking about. So we've talked about RMDs, required minimum distribution. So that's when you have an IRA and you hit a certain age, IRS says you have to take some money out. A QCD is a qualified charitable distribution, meaning it's a distribution out of your IRA that's qualified in that there's something special about it. And so what this does is, after you pass the 70 and a half birthday,
magic number,
because, again, going back to government, how confusing life is, that half birthday, it matters.
Yeah, because the RMD age moved, but the QCD age did not.
Right. So RMDs are 72. This is 70 and a half. So you can actually start giving out of your IRA
before you need to take RMDs.
Required distribution. A qualified QCD, qualified charitable distribution, just says, if I give the money directly from my IRA to a charity and I don't touch the money, then there's no tax on that distribution. Because we know when you take money out of an IRA, and we're talking about a traditional IRA, something that's pre-tax, you owe income tax on that, right? It counts as income. But if I don't ever touch it and it goes straight to charity, the IRS says we will not count it as income, so we'll keep your income lower, and you don't owe tax on it.
Right.
Again, going back to this scenario of why this works on taxes is to say, okay, let's say I am 73 years old, all right? This is when it makes the most sense. And I have a required distribution, RMD, of $50,000. And between my Social Security income, whatever, I don't need $50,000 to live on. That $50,000 is more than I wanted to take out.
Yeah, in fact, you'd rather not. You'd rather not because you're paying tax on it.
Right. So let's say I only needed $30,000 for the year because my Social Security covers everything else. So that extra $20,000 I would pay income tax on. It may move me brackets or whatever and mess up life. So I can say, okay, I'm going to take my $30,000 out. I'm going to give the other $20,000 directly to a charity, and so that I'm only going to show $30,000 income. I'm not going to pay any tax on that, and that charity is going to get more because it's not going to be after. It's pre-tax money they're getting.
Yep.
So that's why it's very valuable. We tell clients that once you hit that 72 age, all of your giving should be considered first through that QCD because you can offset income.
Yeah, if you're giving every week to your church or whatever, you could just
set it up
automatically, or you could do it one time through the year because you might at that point you might know what you want your income to be for the year, and just say X%. Do it.
So those are ways to give to charity. So we got cash donations, appreciated security, giving assets, and then there's the delayed giving, which we talked about through those special trusts, QCDs, which are the IRA. Really the only way to give from an IRA is that QCD. The last one, and this is one we didn't really, estate planning. So that's giving while you're alive.
Right.
And so then the next step is, okay, what if I want to do something post my death? What if I want to benefit a charity afterwards?
Keep on giving.
How do I do that? Right. So the first one is pretty simple. You just name a charity as a beneficiary.
Right.
So when we're going back to IRA accounts, all IRA accounts need, listen to that, very important, need a beneficiary because they bypass your will. Whatever's listed on there is what happens. And so if you wanted to, you could name a charity as beneficiary. And again, with beneficiary, it's not all or nothing. I could have 50 beneficiaries and split it out however I want. It's very confusing. I wouldn't recommend that. But you could have multiple beneficiaries. So you could say, you know what? I'm going to have this IRA. This is where, I saved up my 401k. I rolled it over. I got this IRA. 10% goes to a charity, 90% goes to my kids. You could set it up that way or however you want. Giving that way, there really is no tax benefit because it's in your estate.
Right.
And it's going to be taxed in your state regardless of who the beneficiary is. They don't get a tax break just because a charity is listed as a beneficiary. So it's not necessarily tax efficient, but if you're within the estate planning where you don't owe any estate tax, then it's irrelevant. It's a good way of doing it. There is, though, if you have permanent life insurance, that would be like whole life or universal life that has cash value. gifting that to a charity. So instead of having, life insurance has beneficiaries as well. Instead of just having a beneficiary, but actually gifting it to them, is actually a tax deduction, or possibly can be. So it depends on what asset you're talking about. There could be some, but naming a beneficiary is a great way of giving post your life. But just keep in mind your estate will still count it as an asset normally because you haven't given that up yet.
And this
had it all the way through to death.
These are some examples of why it's good to plan these things ahead of time.
Yes,
because
definitely.
Don't wait. You can't really wait until you're on your deathbed to put all these things in motion. Because
it could be challenged too, because were you in the right mind, all that. So think through. And I know a lot of people though that say, "Hey, you know what? I have a good amount of assets. My family's going to be fine. I would love to make a legacy at these organizations where there's some sort of continued giving type of thing." And naming them as a beneficiary or listing them in your will or trust as a portion of that during the distribution phase is great. It's awesome.
And again, this is where having people like your CPA and your attorney and your financial advisor, the three amigos, so I'm going to call them, all should be on the same page and all should be working together at the plan. If everyone's on the same page, there aren't any surprises, and it's all planned out ahead of time, you're going to... the charities that you're ultimately trying to benefit in the long run are going to be more benefited because of that.
Definitely. And a next one, and this is estate planning, but it also is current as well as future, is a donor advised fund, or a DAF, DAF. There's your other acronym. Donor advised fund is a fund that is controlled by the donor, hence donor advised fund. It's advised in that they make recommendations on the distributions. Whoever's maintaining the donor advised fund actually has the final say in it, but most of those are set up so that they really do what the donor wants, right? As long as they're a legitimate organization you're giving to, the donor advised fund is great. Now, what's cool about these is I give, and whatever year I put money into the donor advised fund is the year I get the tax break, not when I distribute out. So an example is, let's say, again, going back to there's $24,000 standard deduction. And normally I'm in there. So giving doesn't give me any extra benefit from that standpoint. So one thing I could do is give 3 years worth into a donor advised fund. So I get higher than that standard deduction. So I itemize that first year. And then in the next 2 years, because I already put all this money in donor advised fund, I don't give anything more. I just spend out of that donor advised fund. And so you net a better tax over those 3 year period. And so it's kind of grouping in your deductions. Donor advised funds are nice because they have no distribution mandates. Once the money goes in, you get the tax deduction. From then on, it stays in the donor advised fund. You can invest it. It can grow. It can do whatever. And you can distribute as much as you want in any year or as little as you want. There's no restrictions on that. It's great. The downside to those are, one, you can't do certain things with a donor advised fund when it comes to, like, for instance, QCDs cannot go into a donor advised fund. So that qualified charitable straight from IRA cannot go into a donor advised fund. So there's certain restrictions, but overall, if you're giving cash or appreciated securities, a donor advised fund is a great thing to do. The other thing is you control it, so you can choose how you distribute it. You can stretch it out. Again, beneficiaries are important. If something happens to you, you should list somebody to take that over to continue to give out of that as well. Overall, donor advised funds, going again back to 2019, had a $141.95 billion, so almost $142 billion with a B in assets.
That's a lot.
So there's a lot of money sitting there ready to be distributed out to nonprofits.
Right.
Because, again, the rule goes they have to go to a legitimate 501c3.
Right.
They have to be a nonprofit. On the reverse side of a donor advised fund, again, going back to estate planning, private foundations. We talked about that a little bit.
Right.
It's where you set up your own foundation and you can have staff. You can have this whole thing, depending on the size of it. You could have it, but they have rules. I think they have to distribute about 5% per year of their overall assets. They have these certain requirements that the IRS puts on them. There's a lot of paperwork and stuff.
Some of those
but you
are
have complete
huge
control.
too.
There's some really big ones and really small ones.
Right.
Anybody can open one. There's just cost to it. So most of the time it makes sense.
And I'm thinking of like the Gates.
Yeah, Bill Gates Foundation. Yep. There's a lot of foundations out there that do those, and there's millions or billions of dollars in those.
Yep.
But private foundations, you have complete control because you're the one choosing everything.
Yeah.
Donor advised funds, you're recommending a grant, and then the fund itself or whoever's managing it says yes or no.
Right.
Now, again, almost everything is approved as long as it's a legitimate organization, but that's just something to keep in mind.
All right, Josh, let's kind of close it up by some final thoughts. And I wanted to start off by saying that we kind of hit in general talking about 501c3s, but I think that tithing and giving on a regular basis from your income as it relates to your church or faith organization probably deserves its own episode.
Yep.
And
because there's kind of twofold. While I'm working, what does that look like? When I'm retired, what does that look like?
So I think we should dedicate a full episode to that. So we're going to go more into detail of what that will look like in the future. So not that it doesn't apply to what we had just talked about. It does, certainly. But I think we can definitely dig deeper into that. And a couple reminders that we had already mentioned is that standard deduction makes it a lot harder to have enough deductions to claim them in an itemized fashion. So just keep that in the back of your mind and keep track of your cash donations, because even if it's just, a note on your phone, you have the receipts in a box, you have them all laid out so that when you get to, tax time in the spring, you're ready to go. Somehow keep track of those things, because in the unlikely event, let's hope it's unlikely, that you get audited, you have to be able to pull out that receipt or whatever. So
prove it. My final thoughts, first and foremost, when it comes to giving to charity, like I mentioned before, there's really your time, your talents, and your treasures. Those are kind of how I always think of the 3 T's.
That's so cute, Josh.
I know. So your time
T's.
And your talents, those are your skills and your availability, right? There's a lot of nonprofits out there that could use help, right? And so don't overlook that, right? Don't think I only can give through money, right? So think of those two as well as your money and cash. And then second is find an organization that you are passionate about, but do your research, all right? Not everybody's as efficient with their donations as they should be. And so look at where that is. Now, again, keep in mind, these are organizations. There are overhead costs, right? There are staff. There's a lot that goes on to it. And so keep in mind, you're not going to find one that 100% goes to. I'm sure there might be some out there that are all volunteer-led, but in general, you'll find some overhead charges. But just make sure they're being good stewards of the money that you're giving them. And so that, always do your research, pay attention. And then finally, while taxes are great, that's not the primary reason most people give.
Yep.
It's just an added benefit. So, help optimize it. Talk to your advisor, talk to your CPA, talk to your attorney. Optimize what you're doing, because, again, you don't want to waste money that could be going to a good organization. But keep in mind that's not the end-all, which we saw the last couple of years when the standard deduction went up. One of the worries was, especially in nonprofit
people are going to stop giving.
People are going to stop giving. And we really did not see
Correct.
that. And so, which is a positive. Most people are giving because they care about the organization that they're giving to.
Well, as always, check out our free gift to you. It's a brief list of 8 principles of timeless investing. These are overarching investment themes meant to keep you on track to meet your long-term goals. And yes, giving can be a part of that.
Yes.
So that's something to plan ahead for. So check it out. It's free on our website. Josh, how can people help us to continue to grow this podcast and help more people?
Yeah. So first of all, make sure you're subscribed so that you get the alert every Thursday when we drop a new episode every Thursday. Leave your reviews on Apple Podcasts. That helps us rank higher. Helps us rank higher means that more people see us. More people can hopefully benefit from it. And then if you have any ideas, email us at hello@theinvesteddads.com. And then finally, if you know somebody who's asking about giving or would like to know some of this information, make sure you share this episode with them.
All right. Well, until next Thursday, have a great week.
All right. Talk to you later. Bye.
Thank you for listening to the Invested Dads podcast. This episode has ended, but your journey towards a better financial future doesn't have to. Head over to theinvesteddads.com to access all the links and resources mentioned in today's show. If you enjoyed this episode and we had a positive impact on your life, leave us a review, click subscribe, and don't miss the next episode. Josh Robb and Austin Wilson work for Hicks & Zerker Capital Management. All opinions expressed by Josh, Austin, or any podcast guests are solely their own opinions and do not reflect the opinions of Hicks & Zerker Capital Management. This podcast is for informational purposes only and should not be relied upon for investment decisions. Clients of Hicks & Zerker Capital Management may maintain positions in the securities discussed in this podcast. There is no guarantee that the statements, opinions, or forecasts provided herein will prove to be correct. Past performance may not be indicative of future results. Indices are not available for direct investment. Any investor who attempts to mimic the performance of an index would incur fees and expenses which would reduce returns. Securities investing involves risk, including the potential for loss of principal. There is no assurance that any investment plan or strategy will be successful.